I am very curious to know about your next name.
Yeah, so the next name we have up here is a company called Millicom.
Mm.
They provide, it's been described as a Verizon-based company, so they've got a lot of wireless in a number of Latin American countries with it, and they're building a charter underneath it. So basically they're building out this infrastructure, which is key in most of these countries in terms of providing broadband. So in all of their countries, they are players in the mobile market, but they are building this network. In many cases, they bought the local cable providers, and then now are extending out and putting in fiber where it makes sense. And because what's really happened in Latin America and in general in these sort of fiber companies is the cost to pass homes has gone down quite a bit. And so so right now, Millicom can pass a home for $100 and the user equipment's about $100. And therefore they can make a very good return on charging. They charge like $30 a month per customer per month, which is very affordable in the regions where they are to provide.
That was going to be my first question. Is that an affordable rate?
Yeah, and so they're able to get, I think on unlevered returns, they're getting sort of on the mid to high 20% on an unlevered return. If you put the leverage on, you're probably getting like 40% incremental returns based upon working in that market. Like you're saying, that's been a historical constraint in those markets. Why there probably historically hasn't been a lot of growth, because historically passing those homes has cost so much. But now the prices come down. And we're sort of seeing it in the United States. There's a number of people that are doing in the United States. Of course, the in the United States is higher. So the returns are also good there, but this one's really happening in Latin America, and you do have the growth. The other thing these guys have done over COVID, which isn't even reflected in the pricing and the valuation that I've taken a look at, is they've developed a mobile transfer or a fintech type company, which value it on what other fintechs are at is worth the market cap alone. So they have almost this free option in this business. So what they've done, if you look at the way that the company is set up, majority of their profit comes, 67% of their EBITDA comes from markets where there's very few players, where they're one of two people. Their margins are higher as you'd expect in those countries. So I mean, their two biggest countries are Guatemala and Honduras. And if you look at this, one of the issues that I've historically had with emerging markets types of companies, now Poland isn't in this case either, is the currency issue. If you go back, you take a look at Poland over time, it's been flat. These guys, if you go back to 2000, the currency depreciation against US dollar has been like 7 per year. It's been very, very low, which to me provides me a lot of comfort, because you can find these great businesses in places like Brazil, Russia, Turkey. But then in addition to not only being concerned about the business, if you're a US dollar, to be concerned about the currency depreciation, which is something that's totally out of your control, which makes it much more difficult to really find a good bargain there. The bargains have to be so much more of a bargain, and you're dealing with another factor that's out of your control. So that's what I found interesting about Millicom is, despite them being in Latin America, the currency has been very, very strong versus, let's say, alternatives you could find in Brazil or Mexico or Argentina or other places like that where the currency has gone down. So you got guys that have built this system up. The other thing that's unique about Millicom is their management structure. Mark, the guy that's the CEO came from VTR, which is basically the Malone cable company in Latin America, former CEO of that company. So he's the CEO of this company. They've incentivized their managers, which is unusual for an emerging markets company, where all of their managers basically have the ownership guidelines. So the CEO has to own 5 times his salary, the CFO, which is typical for most North American and other companies. But all their managers of their countries have to own at least 0.5 to 1 times their salary. And it's interesting because talking with the company, they've said, these managers are really incentivized to see what's going on with the stock and what can they do to basically increase the stock. And you talk about that capital allocation decision, that's pushed down to these guys. And then they really understand it on a country level. And again, this company has like little or no dividends, but they see so many investment opportunities. So the thing about this company is it's generating all this cash flow. Then the question is, where is it going to go, right? So they have three big areas that they can invest in. They have the two largest JVs they have, they own 50% is in Guatemala and Honduras. And if that happens, that's one of the bigger things.
Right.
The other one is buying back shares. Yeah, and if they buy back shares at their current price, you're probably getting about a 20% rate of return, maybe 30% levered. And then, as we talked about before in the unit economics for the internet, they're getting great economics there. So they have cash flow coming in and great choices to allocate it, and they don't need to distribute it out to anybody. So I find it to be a very interesting opportunity. The uniqueness I like about it is the currency has always been my issue with these foreign funds, but these aren't in it. They've got number one or number two positions in a number of their markets. They do have some markets where there is some risk, but they're very, very low exposure. So, for example, they're one of the competitors in Nicaragua, in Bolivia. There's more risk there, but what they've actually found in Bolivia is they can get decent returns because at least the government there realizes you have to give the companies reasonable returns. But those are much smaller portions of the business. The main companies in this business is Guatemala, Honduras, Paraguay, and then Colombia. So
are they offering these in bigger cities in these countries, or are they playing in smaller towns, or does that make a difference? In
it's all across the country. So I mean, in Latin American countries, so like in Guatemala and Honduras, it's pretty much all across the countries. And then in Colombia, they do have they do have a JV they're working with somebody who's big in Bogota. But their main focus is in Medellin, but they do have, and the other interesting thing about Latin America, just like Poland was a very entrepreneurial, had very democratic sort of leanings before other parts of the world, Colombia in Latin America is very similar.
Yeah.
They've been known as the commerce hub of South America. The reason why drugs are so big there is it's the commerce aspect of the culture and of what really goes on there. So that's why I think it's exciting for them to be involved in that market. And they do have a very large investment opportunity there to continue to, they're competing against more state-owned type businesses. So they do have some real interesting opportunities there. I think what's happened with them from a story perspective, they used to be a majority owned by Kinnevik, which was a very large Swedish conglomerate.
Right.
Dumped their stock. Okay, this happened in 2008. Then they started, they were traded on the NASDAQ. They started to build stuff up. You can see the revenue goes up. They're starting to turn the corner. And then COVID hit. Now, COVID hit Latin America much worse than the developed markets. So that basically and so now they're in the process of going. So they were in a process of actually taking off, and then they got hit with COVID. And then now what's actually happened is it helped them in the fact that they pulled back investment. And then now they're slowly going back and putting investment into other areas. But I think it really added a lot of credibility to their overall thing because they helped these governments. So these governments wanted to get money out to individuals and countries, and they provided their Tigo Money app to basically distribute payments to individuals. Got a lot of goodwill from the governments by providing this. So it's a very interesting story. I think in combination with that, the pricing right now is around, on a look-through basis, probably about 7 times free cash flow. So if you add that together, now the other interesting thing about this model is you do have operational leverage. So as other people have noted, the revenue isn't growing that much. Because the reason that is it's a combination of broadband revenue probably growing like 8 or 9%, mobile revenue growing at 2%. Right now, mobile 60%, 65%, and broadband. But if you what's happening is that higher growth, it's switching more over to that, but the operational leverage in this business is very high, given the amount, just the nature of the business. So you can turn like a 4% revenue growth into 15% free cash flow growth relatively easily. That's sort of like what they've done. Then top of, if you're 14% free cash flow yields, so you're talking about 20 to 30% sort of combined growth and yield you're getting today. And And to me, that really provides a good sort of the rest of the world in terms of this COVID recovery. So this will provide you another avenue to basically play that return to stabilization. I mean, one of the risks of this whole thing is these countries are more, these guys are in a great position. They're building, critical infrastructure, but Latin American countries are going to be more susceptible to shocks like COVID. But that's
right. How do you think about the leverage though? Financial leverage here is much higher relative to your first idea. And I'm just wondering, with operating leverage being that good, that high, and financial leverage being that high, how do you
their focus has been paying down debt.
Okay.
Last year, for example, in their joint venture with Guatemala and Honduras, they didn't have any dividends. They paid down debt. So their focus now is to focus on the opportunities where they see high return on investment to invest and then pay down debt. And then when they want to get down to 2.5 times AV to EBITDA, and then they said they'll feel more comfortable with share repurchases at that point. But I think their focus is correctly now in trying to reduce the debt, because the amount of cash flow they're getting, they can reduce that debt relatively. They should be able to do that. So I think they really can do both. So
I see. Well, that's fascinating. I tend to, we're all going at this from a variety of different angles. I tend to focus on companies that have high gross margins. Capex as a percentage of gross profit is something that I keep a very close eye on. And of course, in a retail business like Adino Polska, you can generate terrific gross margins. It's in the mid to high or low to mid 20%, but the evolution is much, much higher. And in a business like Millicom, I wonder how you kind of take this constant Capex need to continue to grow and Capex as a percentage of gross profit. How do you come?
Yeah, there's really two businesses here. So you really need to break it between the two. Okay. So you've got mobile business, which doesn't require a whole lot of Capex.
I see.
It's growing at a small amount. Then you've got the underlying cable business, which does require Capex because you're putting in new cables. But the cables you put in there are probably going to be there for 10 or 20 years. The nice thing about fiber is once you lay the fiber, to basically upgrade, you just need to drop in a little bit of electronics.
Yeah.
And you get more bandwidth. So they're really building a long-term infrastructure. And so I think if you take a look at it from that perspective, and that's sort of the argument, a lot of the stuff in the United States is that, and what I really think is going to happen over time, we don't see it right now because the applications aren't there, but as more and more video stuff happens, it's going to be a huge bandwidth hog. And all these huge applications, someone's going to come, when the bandwidth's available, someone's going to come up with this application that everyone needs. It's just going to be, it's going to take tons of bandwidth, and these companies are going to be available to provide that service. And it's in my mind, it's almost like in these countries, you're building like a railroad in terms of transportation. That's what you're really.
That's fantastic. Yeah. Capex by itself is, in an energy company, E&P, entity, Capex can be significantly high, and you will not know what the returns are going to be. But if this sort of a Capex is going to differentiate them and provide that monopoly position, that's fantastic. That I do like that.
And that I think is the difference. Like you're saying, I mean, with oil and gas, it's difficult because, like you're saying, you're investing in a depleting asset. So that's a real rough game to play. And the amount of the amount of cash flow you're going to get out of it's dependent upon the price of oil while your well is producing, right? So if it's high, you're going to do well. If it's low, well, you're not going to do not so well. So